In this video, we're going to talk about Paysafe, trading under the ticker symbol PSFE. Right now, there's a lot of volatilities coming out of the financial market, and we should be careful about which stocks to buy, to sell, or to watch after. This video is going to cover the recent price action momentums, the technicals of the stock, and what is my opinion about it. Before the video begins, a quick heads up that my analysis are based on the sessions already completed, and it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock increased to $3.16 before closing the trading day at $3.20. We gotta pay attention to the $3.10 level nearby because it was tested 3 times before, and that makes it a very significant support level for the short and medium terms. Over the past month, the trend of the stock has been ranging between $3 and $4, which means that it is very close to a value region where the upside is maximized. From the perspective of a longer time frame, 6 months and above, the trend of the stock has been bearish because the stock price decreased non-stop ever since it went public, or almost, despite having a business model and a business that has been up and running for a long period of time and a rather large online following. When we look at the price trend overall, I think that the downward trend has been slowing and we seem to have found a very solid floor around $3. But there is still a lot of selling pressure remaining, and we gotta be careful about it. The trading volume of Paysafe has recently been 6.6 million shares versus an average volume of 6.2 million shares. Over the previous 52-week period, its price has fluctuated between $3.03 and $17.96. The market cap of Paysafe is currently at $2.3 billion. Versus an enterprise value of $6.5 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap, which is refreshed every single day, and often more lenient for many startup companies. One key element to note regarding the enterprise value is that for growth-type companies, one of the most significant assets they often own is the goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or grow faster than its rivals, partially because it is assumed that it may have a better management team, a stronger brand recognition, a bigger following online, and so on. It is what makes a company unique compared to other companies in the same sector. In other words, although it's not a tangible asset that companies may use, it's often the reason why companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and because the enterprise value is often less reactive to the market cap in very volatile situations. If the company goes to liquidation though, there would be no goodwill left, and us the shareholders and the bondholders would be distributing among ourselves the assets that are left on the balance sheet, which is likely going to be much less than whatever the number is at the moment. When we compare the current price to the historical price fluctuations, the stock is 5% higher than its 1-month low, 5% higher than its 3-month low, and 5% higher than the 52-week low. On the options market, which often gives a hint on a market sentiment about where the stock price is likely going to head toward, the implied volatility is 118%. Versus the historical volatility of 63%. The put-call volume ratio is currently at 0.45. It is normal for most stocks to also have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 4.6 thousand contracts in a day versus the 30-day average of 6.4 thousands. Regarding the open interest, the most recent volume of open interest has been 200,000 contracts versus the 30-day average of 187,000 contracts. In terms of shareholder structure, institutional shareholders own 40% of outstanding shares. The biggest shareholders include Fidelity, BlackRock, and State Street. It is relevant to understand the shareholder composition of a company because it helps to determine whether you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. This is obviously subject to a lot of exceptions, as many great companies are also mostly held by retail investors, but this so far has been the exceptions and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions that aim to profit if the share price falls lower. Sometimes, when there are significant short interests in the total volume, it can be a sign that there is an organized shorting operation that is happening. The current short volume is just 3% of the total float, and 54% of it comes from the dark pool transactions. Overall, my opinion about Paysafe is bullish despite the recent price actions, because it is now confirmed that the stock will be holding near the $3 level, and that in the grand scheme of things, we gotta be ready to start building a position with the current price levels. The maximum exposure I would therefore recommend is 1 to 3% of your portfolio. For the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are very close to where the stock is right now. I would recommend to separate the allocation in batches of 25% at a time so that you can have enough room to purchase later. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything, other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.